You know that feeling when you open your banking app and there's a little notification waiting for you, and instead of anxiety, it's something that feels like progress. Congratulations, your credit limit has been increased. It's subtle, there's no fireworks, no confetti, but something inside you feels upgraded, trusted, promoted. You didn't apply for a raise, you didn't ask for anything. Yet somehow your access to money just expanded. And it feels good. It feels like movement, like you're climbing, like someone on the other side of the system looked at your file and thought, yes, this person deserves more. But here's the uncomfortable part. That notification isn't about trust. It isn't about reward. And it definitely isn't about your financial progress. It's about profit. And once you understand the real incentive behind why your credit limit keeps increasing, you'll never look at that message the same way again. Because the bank doesn't want you broke. They don't want you maxed out and bankrupt either. That's messy. That's risky. That's unprofitable. What they want is something far more subtle. They want you balanced, comfortable, confident, spending. You are most profitable to a bank when you are almost responsible. Think about that for a second. If you never use your credit card, you generate almost nothing. Maybe a small interchange fee here and there, but that's not where the real money is. If you max it out and default, that's a problem. Collections, write-offs, legal costs. That's not ideal. The sweet spot is you using it regularly, feeling in control, occasionally carrying a balance, paying interest for a few months, then paying it down, then spending again. That rhythm, that cycle, that's where the profit lives. So when your credit limit increases, it's not random. It's not generosity, it's math. You've demonstrated stable income, you've shown repayment history, you've proven that you are safe enough to scale. If you owned a business that made money lending at 20% interest, and you had a customer who borrowed consistently and paid back reliably, what would you do? You'd offer them more. Not because you love them, because the upside just expanded. Credit card interest rates are some of the highest consumer lending rates in existence. Often 18%, 22%, sometimes more. Compare that to a mortgage at 5 or 6%. Completely different world. Unsecured lending. High margin, high yield. That little plastic card in your wallet is not just a convenience tool, it's a revenue engine. And every time your limit increases, your potential to generate interest increases. Even if you never carry a balance right now, the system is built around the probability that at some point you will. Emergencies, travel, lifestyle upgrades. I'll just pay it off next month. The bank doesn't need you to collapse. They just need you to expand. And here's where it gets psychological. When your limit increases, your perception of normal shifts. If your credit limit is $3,000, a $200 purchase feels noticeable. If your limit is $15,000, $200 feels irrelevant. The ceiling changes your behavior quietly. No one announces it. You don't wake up and think, I will spend more now. It's subtler than that. You just feel more breathing room, more flexibility, more access. And access feels like wealth. But access is not wealth. It's leverage. You didn't earn more. You were approved for more borrowing capacity. Your net worth didn't change. Your earning power didn't change. Your investment portfolio didn't grow. Only your potential debt expanded, and yet emotionally, it can feel like you moved forward. That illusion is powerful, because humans associate expansion with progress. Bigger house, bigger salary, bigger opportunity. So when something in your financial life gets bigger, your brain tags it as advancement. But if the expansion is liability capacity, not asset growth, you're not moving forward. You're just widening the runway for potential drag. Banks don't care if your credit score dips slightly because you're carrying a balance. They care about probability and yield. They price in risk. That's what interest rates are. Compensation for uncertainty. As long as you stay within the zone of predictable repayment, you are a highly valuable customer. Imagine millions of people each carrying an average balance of $3,000 to $5,000 at 20% interest. That's $600 to $1,000 per person per year in interest alone. Multiply that by millions. That's not a side feature of the business. That is the business. The transaction points, the perks, the cashback, those are hooks. The real product is interest. And when your limit increases, your maximum possible contribution to that interest pool increases too. But this isn't about blaming banks. Incentives drive behavior. That's it. A bank is a business. It exists to generate return on capital. If high limit, high APR revolving credit is profitable, they will optimize for it. That's not evil, it's structure. The uncomfortable part is not that the bank is behaving rationally. It's that most people don't realize they're operating inside that incentive system. They interpret limit increases as validation, not as scaling of revenue potential. And if you don't understand the incentive, you become part of it without noticing. The system works best when you feel comfortable, when you feel in control, when you feel like you're winning. If you felt trapped, you'd resist. If you felt exploited, you'd withdraw. So the experience is designed to feel empowering. Rewards points, travel perks, higher limits, pre-approvals. It feels like access to a higher tier. But ask yourself this quietly. If your credit limit doubled tomorrow, would your life fundamentally improve? Would your stress decrease? Would your financial independence accelerate? Or would your temptation ceiling simply rise? I've watched this pattern play out over and over. Income increases, credit limits increase, lifestyle increases, stress remains. The numbers get bigger, but the margin doesn't. Because margin isn't created by access. It's created by restraint. Wealth isn't built by how much you're allowed to borrow. It's built by how little you need to. And that's the real inversion here. The bank's profit grows when your borrowing capacity grows. Your freedom grows when your reliance on borrowing shrinks. Those incentives are not aligned. And there's another layer to this that most people never stop to think about. It's not just about spending more. It's about how your identity slowly adjusts to the size of your credit line. When your limit increases, your internal sense of financial capacity expands with it. You might tell yourself you're disciplined, and maybe you are, but human behavior is incredibly sensitive to ceilings. If you walk into a room with a 10-foot ceiling, you feel contained. If you walk into a cathedral with a 100-foot ceiling, your posture changes. Your perception changes. You feel smaller, but the space feels larger. Credit limits work the same way. They expand your psychological room. And when the room expands, what once felt like a stretch starts to feel reasonable. A $1,200 flight upgrade. A new laptop because the old one is slightly slow. A weekend getaway you didn't plan for. None of these feel reckless when you have unused capacity sitting there. In fact, the unused capacity can feel like wasted opportunity. That's the subtle trick. The existence of available credit creates pressure to justify its availability. Not consciously, quietly. You don't think, I should spend because I can. You think, it's fine, I've got plenty of room. And that shift from caution to comfort is incredibly profitable over time. There's also something else happening beneath the surface. When your credit limit increases, it reinforces a story about yourself. It says you are trustworthy, you are financially stable, you are advancing, and humans protect their self-image. Once you internalize the identity of someone who is approved, you are less likely to question the system approving you. You assume alignment. But approval in lending doesn't mean alignment with your long-term goals. It means alignment with expected profitability. That's a very different thing. The bank is running predictive models. They are estimating the likelihood that you will revolve balances, the probability that you will remain solvent, the expected revenue from your behavior over time. And when those numbers look attractive, your limit rises. You are not being rewarded for wealth-building behavior. You are being rewarded for predictable borrowing behavior. That distinction is uncomfortable because it reframes the story. It's not about how good you are with money. It's about how valuable your usage pattern is. Credit expansion often tracks income growth. You earn more, your limit increases. That seems logical. But income growth is one of the most dangerous periods for financial stability if you're not intentional. Because when income rises, lifestyle pressure rises with it. Social expectations adjust. Your peer group upgrades. Your baseline shifts. And if your credit limit rises at the same time, the system effectively lubricates that lifestyle expansion. It makes the upgrade frictionless. No need to save first. No need to wait. Just swipe. Friction is what protects you. Delay is what protects you. When friction disappears, spending accelerates. The bank benefits from acceleration. You benefit from restraint. Another uncomfortable truth is that credit limits are dynamic because your data is dynamic. Every transaction feeds a model. What you buy, how often you buy, whether you carry balances after holidays, whether you spike spending during travel season, how quickly you repay after a large purchase. You are a behavioral profile, not just a customer. And that profile determines your borrowing capacity. The more predictable you are, the easier you are to scale. Predictability reduces risk. Reduced risk allows for higher exposure. Higher exposure increases potential yield. It's mechanical, cold, mathematical. And most people never think about it. They just see a higher number and feel flattered. The real long-term cost isn't always the visible interest payment. Sometimes it's delayed investing. Every dollar that goes towards servicing revolving debt is a dollar that doesn't compound for you. 20% interest works brutally in reverse. If you carry $4,000 for a year at 20%, that's $800 gone. $800 invested at 8% over 20 years becomes thousands. The opportunity cost compounds silently. And because the debt feels manageable, the urgency never arrives. You don't feel crisis, you feel normal. That's why the system doesn't need you in distress. Distress creates resistance. Normal creates continuation. There's also the cultural narrative around credit scores. People celebrate high credit scores as badges of financial success. And while a strong credit profile can be useful, it often correlates with being deeply integrated into debt products. You can have an excellent credit score and minimal net worth. You can have access to enormous borrowing capacity and very little invested capital. But the system conditions you to optimize for approval metrics instead of ownership metrics. You feel accomplished because your score rises and your limit increases even if your assets aren't growing at the same pace. That misdirection is subtle. It shifts focus from accumulation to access. And access, again, is profitable to the lender. So what do you do with all of this? Not panic, not overcorrect. Just recalibrate what you celebrate. If your credit limit increases, treat it as neutral data, nothing more. Don't let it change your baseline. Don't let it redefine what feels affordable. Anchor your lifestyle to income and investments, not to available credit. Measure progress by net worth growth, by cash reserves, by decreasing reliance on debt. Because the real upgrade is optionality. The ability to walk away, the ability to pay in full without thinking twice, the ability to ignore the limit because you don't need it. When you reach that point, the notification truly becomes meaningless. And that's power. Not because you rejected the system, but because you understand it. The uncomfortable reason your credit limit keeps increasing is rooted in incentives and probability. But your response to it can be rooted in clarity. And clarity is what separates participation from control. The bank increases your limit to increase potential profit. You decrease your reliance to increase actual freedom. One compounds interest against you. The other compounds margin for you. And margin is peace. Margin is choice. Margin is the ability to say no without panic. That's the real upgrade, not a higher number on a credit line, but a lower dependence on it. When you understand that, the notification loses its emotional charge. It becomes what it always was, a business decision, and you get to make yours.